Imagine a scenario where inflation is lurking in the shadows, waiting to pounce on the U.S. economy. This might seem like a distant threat, but the latest wholesale price index report from the Bureau of Labor Statistics reveals a startling 0.9% increase in July, far exceeding expectations. But here's where it gets interesting. This surge in wholesale prices could be a sign that inflation is still a significant threat, even if it hasn't yet affected consumers. The Producer Price Index, which measures the prices of final demand goods and services, saw its largest monthly increase since June 2022, with a 0.9% jump compared to the predicted 0.2% gain. And this is the part most people miss. Excluding food and energy prices, the core PPI rose 0.9%, surpassing the forecast of 0.3%. The index excluding food, energy, and trade services was up 0.6%, the biggest gain since March 2022. On an annual basis, the headline PPI increased 3.3%, the largest 12-month move since February, and well above the Federal Reserve's 2% inflation target. Services inflation played a significant role in this increase, rising 1.1% in July, the largest gain since March 2022. Trade services margins climbed 2% amid ongoing developments in President Donald Trump's tariff implementations. Notably, 30% of the increase in services came from a 3.8% rise in machinery and equipment wholesaling, while portfolio management fees surged 5.4%. And airline passenger services prices climbed 1%. The implications of this report are far-reaching, with stock market futures falling and shorter duration treasury yields moving higher. Although the PPI is not as closely watched as the Consumer Price Index, it provides crucial information on pipeline prices, which, together with the CPI, feeds into the Commerce Department's Personal Consumption Expenditures Price Index, the Fed's primary inflation forecasting gauge. As Clark Gurenin, chief market strategist at CalBay Investments, noted, the fact that PPI was stronger than expected and CPI has been relatively soft suggests that businesses are eating much of the tariff costs instead of passing them on to the consumer. Businesses may soon start to reverse course and start passing these costs to consumers. But here's the controversy. With the CPI coming in around expectations earlier this week, markets had been pricing in a virtual certainty that the Fed would lower its key interest rate in September. Following the release, market-implied odds of a September cut decreased, but only slightly. Chris Zaccarelli, chief investment officer at Northlight Asset Management, wrote, "The large spike in the Producer Price Index this morning shows inflation is coursing through the economy, even if it hasn't been felt by consumers yet." However, the White House countered that the report's details showed businesses were not passing through the costs of tariffs to consumers. And this is where it gets contentious. The reports come amid escalating questions over BLS data accuracy, with Trump earlier this month firing the former BLS commissioner and intending to nominate Heritage Foundation economist E.J. Antoni as the next head of the bureau. Antoni has been a critic of the BLS and has even suggested suspending the monthly non-farm payrolls report until data accuracy can be better ensured. The BLS has been hamstrung by budget cuts and layoffs, forcing it to alter the way it collects data. July's PPI report was the first since the Bureau eliminated some 350 categories from the exhaustive count of input costs. So we have to ask, what do you think about the current state of inflation and the potential impact on the U.S. economy? Do you agree with the assessment that businesses are absorbing tariff costs? Or do you think they will eventually pass them on to consumers? Share your thoughts in the comments below.